Hello everyone, thank you so much for joining again. Today I would like to talk about relative valuation in finance. We have two relative valuation methods. The first one is what I'm explaining today. We call it trading comms, comparables, comms, multiples. So there are many names. That's why most of the students, young professional, sometimes mix it up a bit. I like trading comms best because what it does is it estimates the value of a company. That's what we are interested in by comparing it with similar companies, peer group, using one or more valuation multiples or ratios. So quite simple. That's why we call it relative valuation. Trading comms, we want to value the one company, enterprise value, and we look at other companies and do a quick comparison. It is quite simple how we do it, and there are different ways of basically comparing. Before we get started, why are we using this? First, when we look at the company that is not publicly listed, we sometimes have issues to find the right information, especially when we look at information we need for a discounted cash flow analysis. It's quite easy to get EBIT, net income, revenue data to basically develop your free cash flow profile. However, when we look at the denominator side, when we look at weighted average cost of capital, cost of equity, cost of debt, it's sometimes quite difficult to get information, especially when you recap cost of equity. We are using a capital asset pricing model. We need a beta to find our discount rate. It's really hard to find if we don't have a publicly listed company. So what we do, we look at other companies where we have more information, and then basically we compare those companies. We extrapolate your company with those. I don't like the term that we say it's valuation. I think it's not a real valuation exercise. I think it's more a kind of pricing exercise because it's quite simple. It's not intrinsic. It's basically just a simple comparison. Again, why are we doing this? Simplicity, speed. It's super easy, super simple. We don't need to do number crunching as we need for DCF. Because we are using other companies and we use their market value, their enterprise value, their current EBITDA. So there's a reality check. If we use a DCF, sometimes it can be sensitive to assumptions like growth rates, discount rate. Here we look from a market perspective, so has a positive but also kind of negative characteristic. And then also it's very popular, especially in private equity. When we want to get a fast idea what the company should be valued at, it's very easy to do. When we look at trading comms, this is what we are doing today. I do another video where I talk about M&A comms, which is a bit different because it doesn't look at other companies. It actually looks at other transactions. When we look at trading comms, what we do is we look at how other companies are traded. We have basically three types of multiples. The first one are equity multiples. It's called equity multiples because we are using equity information. Price to earnings, PE, price to book ratio, share price divided by book value per share, or when we look at price to earnings, share price, earnings per share. Very important here, and this is applicable for both multiples. We usually assume or ensure that the numerator matches with the denominator, meaning share price information and earnings. If you look at earnings, also called net income, and then per share, Net income is available to equity holders only. That's why we can compare or use net income / earnings with share price. This is an equity figure as well. When we look at enterprise values, here enterprise value equity plus debt enterprise value, then what we do, we look at EBITDA. EBITDA in our income statement is way higher, and because it is before interest, taxes, EBITDA is usually available or is always available to equity holders and to debt holders. Yeah. So when you use different multiples, we want to ensure that the denominator matches with the numerator. If it's a figure like EBIT, DA, EBIT, or even revenue, these are all enterprise value figures because those cash flow approximations are available to both equity holders and debt holders. Whereas when we look at equity multiples, here we only look at the equity side. There are way more equity multiples which you can use. Enterprise multiples, enterprise value divided by EBITDA, EV divided by EBIT, EV divided by revenue. We have a few specific ones. This is actually not enterprise. 3 is industry specific. Price per square meters, enterprise value over subscribers, enterprise value over reserves in oil and gas. Here subscribers for like tech companies. So you can come up basically with very creative ratios to get an idea, and I show you how. Let's do an example. So let's assume, very simple, let's assume we want to value XYZ company. We don't have much information, we don't have beta, we don't have a discount rate. It's very difficult for us to do a DCF. The only thing we know is that it has an EBITDA of 0.3 billion, and we know there are 100 million shares outstanding. Yeah. So what do? We look at other companies, comparable companies. Here in our example ABC, we call it peer group. It's very important that those companies are as similar as possible to the company we want to look at. Yeah, even if you want to look at Volkswagen, using Tesla is already critical because one company is mass market, the other company has a smaller profile. Okay, Tesla has entered into the cheaper cars as well, but it's really important to look at whether the companies are actually comparable or not. Yeah, so you want to ensure the company is as similar as possible. Then for the peer group, we assume that more information is available. For example, market cap is our equity based on the current share price times shares outstanding. So we assume those peer group companies are publicly listed. Otherwise, it would be hard to get market cap in those informations. If we do it for those companies, let's assume we can pick any of those ratios or multiples. In practice, we would use a few and then do a kind of average and get a better understanding, because again, these are all references. We don't know, there is no right answer. But here I want to use EV over EBITDA as an example, because we have EBITDA information available and we want to understand our enterprise value for XYZ companies. So what we do first is we create our ratios for those comparable companies. For A, it would be, if I look at EV, for B, EV, for C, EV would be 2 plus 0.4, 3.2 plus 0.8, and 2.6 plus 0.7 would be 2.4, 4.0, and 3.3. So I have my EV. I also have my EBITDA for those numbers, for those companies. So what I can do is I can create my ratio right away. So my EV EBITDA ratio for company A equals 2.4 billion. divided by 0.25 billion. Here the same, 4.0 billion divided by 0.4 billion. And then the last one for C is 3.3 divided 0.32 billion. Yeah, it's all in billion. Yeah, so we create our ratios based on the peer group. The answer, if I'm not mistaken, would be 9.6 times, would be 10 times, and would be 9.7 times. We would take an average out of those three. Average here, if we take the median, would be 9.8. Let's assume 9.8 is our average. This is the ratio we are using. And then basically what we do, we use this multiple with our XYZ company. So what we do is we have EV equals 0.3 billion, which is EBITDA times EV EBITDA. This is our multiple here times 9.8, and then EV. So what we then have is basically 2.94 billion. Yeah, so we have created a multiple, EV, EBITDA multiple, or any other multiple, depending on information available. Have used a kind of average. 9.8, we could do even more companies, 4 or 5 companies. Then we have 9.8, and then we multiply with our EBIT. So we get 2.9. And if you really look at what we have done is, you can see here, enterprise value for company A is 2.4, enterprise value for company B is 4, and here 3.3. So company XYZ is somewhere in the middle between A and C. And then also it makes sense because when you look at the EBITDA figure, it's very close to 0.32 billion, very close to this one. So it is close to 3, which it is. We are at 2.94. Yeah, so that's all we do. Same if I want to do with EV subscribers, and I have, let's say, one peer group, company A has an enterprise value of 500 million and has subscribers of 100, just making this up, 100 subscribers lead to 500 million. And my XYZ company, EV, I don't know, but I know I have subscribers like 50. Let's assume our XYZ company has 50 subscribers. We know there's a comparable company that has 100 subscribers and has an enterprise value of 500. Then I can compare, extrapolate, and know, okay, my enterprise value should be 250 million. Half. Subscribers is half, enterprise value is half. And this is very important because whatever we do with multiples, relative valuation, whether we look at trading comps or in my other video, M&A or transaction comps, it's the same process. We are just comparing. We are just extrapolating, looking at, okay, what is the EBIT figure? What is the subscriber figure? What is the reserve figure? What is the implicated enterprise value? And what does it mean for my company? Yeah, very simple, very easy. What are the advantages and limitations? First, as said, it reflects market sentiment because we're using market data from other companies. It actually captures actual pricing, which sometimes can be good and sometimes can not be good, but at least it reflects market sentiment. It's quick and easy, as we just saw. You didn't need to do Excel modulation, quite simple, and it's widely understood. You can communicate very easy. The numbers are simple. Limitations, it requires a really good peer group. If there are no true peers, your multiples may be misleading. Subject to market mood, market sentiment. If the entire sector is overvalued or undervalued, your target valuation actually may inherit that bias. And then also accounting differences. We have used, for example, EBITDA. If you use EBIT or earnings or any other numbers, because of accounting differences, depreciation, amortization may be different. So your underlying number that you're using, for example, EBIT, may be different. So it will give you, can actually distort your multiples. Yeah, good. I hope you found this useful. I will do another video for relative valuation methods 2 out of 2, which will then be focusing on M&A/transaction comps. Thank you so much for listening. I hope you found this useful. I see you in another video. Bye bye.